The dollar is holding near a two-week high. This as investors expect another set of solid US employment data later today. Non-farm payroll figures, of course, published today at 1:30 p.m. UK time. Joining us now, Kully Samra, Charles Schwab, UK Managing Director. Alberto Gallo, still with us. OK, so the market's expecting solid data once again. This is consistent with a path that looks pretty solid right now for the US economy. This is the last payroll number we get before Jackson Hole. Anything in here that's going to surprise the market, that's going to tell us that the US economy isn't on a tear right now?
I don't think so. I think the bear case for this jobs market recovery has been what's been happening with average hourly earnings, which have been pretty mute. Normally, when an economy is at full clip, you'd expect 3 to 4% growth in average hourly earnings. We're getting about, what, 2.6, 2.7?
Tells you there's more slack in the economy than maybe that you would normally expect at this point.
It might be slack in the economy, but I don't know about slack in the labour market. That's really beginning to tighten now. The NFIB, the National Federation of Independent Businesses, who employ 50% of the labour force, have continually been talking about this tightness in the labour market. And I think one of the other areas that the bears have been talking about with this jobs recovery has been productivity. And one of the things that was pointed out in the Q2 GDP number is that productivity has actually doubled now. From 2011 to 2016, productivity was growing about 0.7% on an annualised basis. Now it's growing at about 1.5%. So I think productivity is starting to improve. We'll start to get improved average hourly earnings growth. So I think that'll show a strong picture in the US.
I mean, we're expecting a little bit maybe of, wage growth increase from construction, manufacturing. I guess, the two sectors that showed pretty strong growth. But how much will they be hit by trade wars? And that's what the Fed should be looking at.
Yeah, I think everybody's going to be hit by trade wars. If you look at the number of times that the word tariffs was used in Q2 earnings report, it was 3 times the amount that we saw in Q1. So clearly everybody is concerned. And the thing that we keep reminding investors, while this is a politicised exercise, it's about the president talking to his base, it's the base that is going to get hurt. It's the end consumer that gets hurt by this. So you do wonder how much of this is rhetoric. We heard Steve Mnuchin talking about closed doors discussions going on, and we saw what happened with the EU last week as well. So one hopes that calmer heads prevail and this doesn't turn into an all-out war, really.
Okay, overall, I mean, is this a good month to be looking at it? I mean, will the Fed read, that much into it? Because it's also the month where a lot of the auto plants close down. I mean, it's an odd month, let's be frank.
It's also an odd month for average hourly earnings as well, because the way that payments work, some of those haven't been captured in the full calculations as well. So absolutely, it's an odd month, but we're talking about it now, so it's widely expected. And, it's not going to sway the Fed one way or the another. We've seen, 90% chance of rates going up in September and a very high chance later on in December as well. But I think it's about the overall picture. Non-farm payrolls on average have been about 215,000 for the year, and that's what we want to see, just this longer-term continued strength in the picture. I know the GDP report last week was dismissed by some as a sugar high, and the question is this more sustainable? We believe that the truth is somewhere in between. There were some great things in there, whether it's CapEx or some of the other things that were going on with consumer spending. So I think it's a good time to invest.
We could spend a lot of time getting in the weeds on this. Who cares? The Fed's on rails, isn't it? The bar for Jay Powell not to do what he has said he's going to do is somewhere up there.
It's on rails for the short to medium term. Remember, it's not far from here that they'll actually get to a neutral level with rates. They've been very accommodative, it's been very slack, and also don't forget, quantitative tightening is also upping the pace as well. So while it looks like the bar is, or the Fed is on rails for the shorter term, I think for the medium term, things are a little bit more uncertain as to what's happening with financial conditions in the US.